benefits of investing in real estate. First of all, know that there are 4 steps you should take when you're thinking about getting involved in real estate. Step number 1 is the goals, your final destination, why you are even investing in real estate. This is most of the time the most overlooked thing, and it is the most important. Step number 2 is the strategy. The strategy is what you use to get you to the goal. Then you have the financial picture. Understand this, that real estate is pure numbers. It is nothing but math. It is a financial vehicle, just like a stock or a piece of intellectual property, to get you a return. That's all a piece of real estate is. And last but not least is the exit strategy. How are you going to exit the real estate deal? So step number 1, the goals. Remember, begin with the end in mind. You have to ask yourself, why is it that you are investing in real estate, and what do you want your life to look at like when you are done and you are completed with your real estate cycle? Always work it backwards. I recommend start with 20 years out, then do 10, 5, 3. Then you can even go down to 1 year and even 6 months. But have an end destination and start working it backwards. And these are all tied to the strategy to get you to the goal. And remember, what does a good deal look like to you? The answer is it depends. You don't fall in love with the deal. You fall in love with the results of what the deal will get you. So you have to ask yourself, a good deal could be different for every person because every person has a different goal and every person has a different strategy. So you want to be very careful when you're asking people if this is a good deal for you, unless you have been clearly able to identify and explain to them what your goals and what your strategy is. So let's talk about the strategy. First of all, you have cash flow, you have equity capture, appreciation, depreciation, principal paydown. Each investor will weigh these benefits differently, and what is important to one may not be important to another, and we're going to discuss this. So let's look at a sample deal. You have a $150,000 house that is going to give you $200 a month in cash flow. My question is this a good deal or is this a bad deal? The answer is it depends. It depends on your goals and it depends on your strategy. So let's say you were able to purchase this house for $120,000, which gave you $30,000 in equity capture. This is the only type of investment that I know of that you can sign a contract, close on a property, and you could get $30,000 in unrealized capital gain. Now understand that this money does not go into your pocket, but the house is worth $150,000. Someone sold it because they had some personal motivation and they sold it for $120,000. Okay. The next is you are going to put 20% down, let's say, on this property, which is $24,000, and the bank is going to give you $96,000. So the bank is going to loan you 80% of the value of this property. There is not another investment vehicle out there that you could get an 80% leverage position. Now, who pays that $96,000 back? The tenant. That's called debt pay down. So you're going to be into the deal for $24,000 and you're going to get a loan for $96,000, and that tenant through rent will be paying that debt down to zero over the course of 30 years. So understand this, property doubles in value on the East Coast and West Coast every 7 to 9 years. And in the middle of the country, it's every 12 to 15 years. The structure depreciates, the land value appreciates. So let's say you had this house for 30 years and you bought it for $150,000 in Texas. That means it will double in 15 years from $150,000 to $300,000. And then in another 15 years, it'll double again to $600,000. Now, if we want to say that we want to be conservative, we can say the house is worth $500,000 after 30 years of time. Remember, you put in $24,000. That's 20% down. Now, when a house is worth $500,000, you've only put 4.8% down. After your $24,000 is returned back to you in cash flow, your return is now infinite. You have no money into the deal and it is all cash flow. The key to this is what goes up as the value increases. Does your mortgage go up? No, the mortgage is fixed normally. Taxes and insurance, they may go up a little bit, but not too much. The most important thing you have to remember is as the property goes through $200,000 in position, $300,000, $400,000, so does the rent. When the rent goes up, so does your cash flow because you have fixed costs. The challenge we all have as investors is most people will look at a deal of what it is doing today. As example, this deal was worth $150,000 and only giving $200 a month cash flow off. And they say it's not a good deal, but yet they don't want the property until it's time for them to retire. Well, when you retire and the house is worth $500,000, and let's just say it's giving you $4,000 a month in rent, now it is a good deal. But you make a decision today based on a future goal. The number one reason that you should buy and hold a property is appreciation. Nothing can outpace appreciation. Cash flow, equity capture, depreciation, nothing will outpace appreciation. And that is the reason most investors will buy and hold. And again, that's based on your goal. And this is a major part of your strategy. Just remember, investing is numbers. It is pure math. There is no emotions that go involved into investing. Last but not least, you have your exit strategy. Part of it could be flipping the property. You could sell the portfolio. You could live off the cash flow. You could possibly pass it down in inheritance. You could do a 1031 tax-deferred exchange, or you can wait. Just remember that waiting is a strategy. Not saying that you have to sell the property, but you always want to think about how you are going to exit the property as part of your strategy.